Hi, I'm Ed D'Agostino from Mauldin Economics, and today we are talking about stock market volatility. If the market has you concerned, you're not alone. A lot of people are asking, is now a good time to buy or to sell? And how do I protect my portfolio? That's what we're going to be discussing today with my good friend Jared Dillian. He's had a long career as a trader at one of the biggest banks on Wall Street, and today he's the founder of Jared Dillian Money. Thanks for joining us today here at Global Macro Update. Jared, thanks for coming back. Always good to see you, my friend. Appreciate you joining us again.
Let's talk. It's been a while.
It has been a while. It's been a while, and it's been an interesting while, right? I mean, what a stark contrast this year in the markets versus last year. Speak stock markets, right? You've got S&P 500 last year up over 23%. This year, so far, year to date, down around 4%. Not a huge loss, but still, I think people have forgotten that the market sometimes goes down. NASDAQ's even worse.
From peak to trough, the S&P was down about 10% at the worst point. And that was about the smoothest 10% loss I have ever seen in stocks. Like, if you go back to August 5th of last year during that yen carry blow up, market was down 8% and the VIX went to 80. Okay. So here the market was down 10% and the VIX went to like 25. Like really not a lot of panic, which is worrisome. Like you like to see that panic. You like to see that capitulation, which is what we saw, last August. I was at a party over the weekend and I was talking to a guy. And he's got a sizable 401k. It's 7 figures. And it's all in index funds, S&P. And he says, when do you think is a good time to buy? It's not usually the questions that you get with the market down 10%. I'm like, look, man, I can tell you, like it might be a lot lower than here. But the question was not, do you think we're going to get a rally so I can sell? He's like, no, tell me a good time to buy. And this is a guy who is 62 and is pretty close to retirement. He's going to retire in 3 years. So that's the mentality.
How do you feel about sort of the underlying aspect of the market where the Mag 7, right? The Magnificent 7 stocks were responsible for a huge amount of the last 2 years run up. And now you could argue Tesla and Nvidia are pulling the entire S&P 500 down some.
I was on a podcast a few months ago, like kind of right when the decline started. And the host asked me, she's like, do you think there'll be a rotation? And I'm like, look, like anytime the market goes down, you always have a rotation. And it's usually pretty predictable. You're usually getting out of high risk stuff into low risk stuff. So tech into staples and stuff like that. And that's exactly what's happened. Like, so you've had that sort of that classic risk off rotation that's happened. The difference is this time, with the Magnificent 7 being like 35 or 40% of the market, like if that rotation by definition means that the market is going down, so the question is this a 3-month phenomenon, or is this the beginning of like a really big secular shift, like a style box trade from, large cap growth into small cap value or something like that? I saw a chart of that recently that looked pretty compelling. Like you started to get an uptick in small cap value. So the thing with these style box trades is they can just trend forever, and it's kind of tough to tell if, look, I mean, maybe today, Trump speaks and the market's up 4% and then it makes new highs and the Mag 7 come back. I mean, it wouldn't surprise me if that happened because that's happened like 10 times over the last 3 years, So you have to be careful around these kind of things.
I hear you that there's still a lot of greed in the market among individual investors, though it seems like maybe the professional investors are taking the opportunity to sell rallies. What do you think the risks are to the market right now? Is it earnings? Is it valuation? Is it strictly political?
I really think it's macro. And I think you're talking about like big flows out of the US and into international stocks or bonds. Like the risk is the dollar. If the dollar goes down 10%, 12%, 15%, there are going to be trillions of dollars coming out of the US and going overseas, right? Like that's what's going to happen. In the first quarter of this year, European stocks were up 10% and the S&P was down 6%. 16% outperformance, right? And that's with the dollar going down about 3 or 4%. So imagine if the dollar continues to weaken for, years, like I don't know if you remember what like the mid 2000s were like, but that, valuations in Europe actually were really high. I think the PE of like the Euro stocks got to like 30 or something like that. Like, so, this can go for a while.
What's interesting is your friend at the party asking you when is a good time to buy, like not asking you what should I be doing, right? Like, just like tell me when to buy. Like I've already decided what I want to do. Tell me when. Instead of, hey, what should I be doing right now? Which you're not a financial advisor. You've had a long career on Wall Street, and you're a trader and an investor. It's just interesting. Like nobody seems to yet be saying, with all this volatility coming back, how do I maybe protect all the gains that I've had over the last few years, and how do I protect my portfolio stacked with index funds? How do you protect your gains?
There's really two ways to do it. Number one is you can just sell it and go to cash. And most people don't like that answer because they're like, well, what if it keeps going up? So they have FOMO and they don't like that answer. The other thing you can do is you can do it with options. Now, kind of hard to do in a 401k. Kind of hard. Look, it's not trivial. You can, if you have, let's say you had a portfolio of index funds, S&P, NASDAQ, stuff like that, that was worth $1 million. You could buy 35 S&P puts like on SPY down like 10%, like 90% strike, and you could have a pretty good hedge on that portfolio. The problem is that nobody knows how to do that, right? Like nobody knows how to do the calculations. Nobody knows the right amount to buy. Nobody knows which strike to pick. Nobody knows which month to pick. And the funny thing about all this is that we have insurance on everything. We have insurance on our houses. We have insurance on cars. We have insurance on boats. We have insurance on our lives. Nobody has insurance on their portfolios. There's a lot of people like their liquid assets make up most of their net worth and they don't have any insurance on it. Now, that's not to say that you should have insurance because insurance in the stock market is very expensive, right? Like you could pay several hundred basis points a year insuring a portfolio, right? So it doesn't necessarily mean you want to do it all the time, but when the market goes up 20 or 30% a year for 3 years and you're sitting on all these gains, like it's time to buy some insurance.
So that's interesting that you say that's what you should use options for, because a lot of what you hear about with options, I haven't heard about it too much lately, but over the past couple of years, the options were always sort of coupled with like 0 day to expiration options, or essentially get rich quick schemes or gambling, right? And that's not what you're talking about.
No, it's not what I'm talking about. So what I do pretty much all the time, or like half the time, is I have some hedge on my portfolio. And I do it with very long dated options, like as far out as you can go, like 2 years, 2.5 years, something like that. And I will buy a put option that is like, say, 70% strike, like 30% down. Okay. I am not betting that the market is going to go down 30%. Market is probably not going to go down 30%. And even if it did, I wouldn't really be happy, right? Because that would mean that I'm losing money on my portfolio. So I don't want that to happen. But the reason I do this is because long-term options have a lot of vega, which means they have a lot of sensitivity to implied volatility, right? So if we get some dislocation in the market where you get a 10 or 20% crash, right? Those options will explode in value and then you can sell them, right? So I actually did this before the pandemic. It was one of my greatest trades of all time. So November of 2019, volatility was crushed. The VIX was like at 11 or 12 or something like that. In 2019, the market had been going up for a couple years, and I was very uncomfortable. And I said, I'm going to buy some protection. So I bought some, I think 1 year S&P puts down like 20 or 25%. March of 2020, the pandemic happens and the market goes down 35%, right? Just to put this in perspective, I don't remember the prices I paid for the options, but I remember the dollar amounts. The dollar amount I paid for the protection was $2,500. I sold those options for $70,000.
Wow.
Right?
Wow.
So that's why you do it. Now, I actually lost more than 70,000 on the portfolio, right? But I made $70,000. Like the hedge worked, you know?
Yeah.
That's just a hedging technique that I do pretty much all the time, you know? Buy some long dated options. They have a lot of vega. You get a big vol spike. If the market crashes, then you sell them and it works out.
That big gain percentage wise that you made, did that kind of take the edge off and let you stay invested in the rest of your portfolio?
Yes.
Okay.
Yeah.
Okay. What if you have the opposite view? What if your friend from the party asked a slightly different question and said, look, I think the market is at a bottom. But I don't want to go all in. Instead of saying, tell me when to buy, like could there have been a different strategy that he would have employed?
I think the S&P is going to go down another 6 or 7%. I think ultimately it's going to go down like 16 or 17%. And then we're going to have a bottom, right? So what I would do in a situation like that is I would do a risk reversal. Okay. So let's say the S&P goes down to 5,300, right? I would sell the 5,100 puts and I would buy the 5,500 calls. So the reason risk reversals are really good, like at bottoms, like in a market crash or something like that, is that vol goes up, but that's not really what you care about. What you care about is skew. Like skew goes up, and skew is the price of downside options relative to upside options. So the puts will get very expensive. So you sell the puts, which are expensive relative to the calls that you're buying, right? That's a great trade to put on if you're trying to pick a bottom at something. Now, the danger is that you sold the puts, so you have unlimited downside. So if you're wrong, it could be catastrophic. But if you're right, it's really the ideal trade to do.
If somebody is listening to this and they're intrigued, right, but they're lost because they're not familiar with options, or more importantly, the right way to use options, you have a solution, right? The reason I even started thinking about what we were going to talk about for this interview is you sent me your new Options Masterclass, which is phenomenal. I learned so much reading this. I've always been curious about options. I've played around a little bit on my own, but it's not something I've always felt comfortable with. I knew enough to know that I could get myself in real trouble, using them. So tell me a little bit about your approach to options in general, how you think about them, and this masterclass that you did.
There's generally two types of people who trade options. There's people who buy options all the time, and there's people who sell options all the time. Okay. So I have a friend from Lehman Brothers. We're pretty good friends. I knew him pretty well. And, I'm friends with him on Facebook, and he moved to Miami Beach and grew his hair out. He's got long hair. And I'm like, what is going on here? So one time I was in Miami and I had drinks with him, and he's like, yeah, I just left Wall Street and I just trade my own money. So I'm like, well, what do you do? Like, what's your strategy? He's like, I just sell options. So, so he not only does he sell options, he sells like teeny options. He sells stuff that just will never go in the money, like sell stuff at like a nickel, a dime, a quarter, whatever. He just sells teeny options like all over the place. He with the money that he made from doing this, he bought a condo in Miami Beach, $2 million. Bought a condo with the money he made selling options. During the pandemic, he almost got carried out. He literally almost went bankrupt, but the market came back and he was fine. So,
but probably grayer. His long hair is gray now.
Yeah, but I do not recommend doing that. I do not recommend doing that. Then you have people who buy options all the time. They buy puts, they buy calls, they buy puts, and there's a saying, I don't know if it's true, but that 90% of options finish out of the money. So if you go around buying calls and puts, then you're just going to bleed to death over time. Really, the idea is to, and I talked about this in the beginning of the Options Masterclass. I talked about this interview question that I got at my trading firm, and about rolling the dice and expected value and stuff like that. Like basically, the idea is over the long term, if you buy options that are cheap and you sell the ones that are expensive, it will work out in your favor over time, right? So one of the things that I kind of can't teach, I try, is how to tell when an option is cheap or rich, right? Which takes a lot of experience. Some options are obviously expensive, like GameStop, when stuff was trading at 500 vol, like obviously expensive options. Then you have obviously cheap options, but there's a lot of stuff in between you don't really know. Like Nvidia at like 50 or 60 vol, is that cheap or expensive? It's probably about fair. Like it seems high, but it's probably about fair given the volatility of the stock. So that just takes a lot of experience.
When should you use these 0-day to expiration options?
Never. They're not, I don't even really consider them options, right? Because if an option has 0 days to expire, basically hours to expiration, like it's an instrument that has, and I talk about this in the course, but it has infinite gamma, right? So let's say the S&P is at 5,500. Now let's say it's at 5,490 and you buy the 5,500 calls, right? Well, an hour before expiration, those options are worthless. And then the S&P goes from 5,490 to 5,510 and those options are worth $10. Right. So it's all gamma. They're like, so I like really what makes an option is the optionality, which is the vol, right? The implied vol. And it like short-term options are almost like binary options, like it's, they're only good for pure speculation. They don't really serve any economic purpose whatsoever.
So who's using them? Is it institutional investors that are hedging for the day, or is it just people on Robinhood that don't fully appreciate the risk that they're taking?
I would say it's a mixture of Robinhood people and hedge funds. Hedge funds do use them. Hedge funds that trade aggressively, intraday they do use, and the funny thing is that you can kind of see the effect of it in the market. Like if a hedge fund buys 10 or 20,000 0 DTE options, like that is a huge amount of short gamma in the market. So whoever sold those options has to hedge very quickly when the market goes through that strike. So then you have this really high velocity move through the strike. It's usually because of something like that.
Still sounds risky to me. It all sounds risky. You talked about a couple of concepts that are native to options, right? You talked about Vega and Gamma, the Greeks, right? When I got to that section years ago, when I tried to teach myself about options and I got to the Greeks, I just put the book back on the shelf. So tell me a little bit about like, what do you learn with this options class? And I don't mean to turn this into an ad, but this options masterclass is really, really good. And it really explained things in a in a layman's way, so anyone can understand it, which I appreciated.
Anybody can use options, right? Like, so the thing about the Options Masterclass is it assumes sort of a higher IQ than the person who's going to buy options for dummies, right? If you buy options for dummies, you're going to get the hockey stick diagrams, calls go this way, puts go this way, whatever.
You're going to get what you deserve.
Yeah, I mean, and you can trade options that way, but I think most people would benefit from a little bit of an understanding of the math behind it. So, with options, there's an options pricing model called Black-Scholes, which was developed in 1973. And it's a closed form equation that it basically, you plug in 5 variables and it gives you the value of an option. And the 5 variables are the price of the stock, the strike price of the option, the time to expiration, the volatility, and interest rates. So if you know those 5 things, you know the price of the option. But usually we already know the price of the option because you see it on the screen. And we know the price of the stock, and we know the strike price of the option, and we know interest rates, and we know time to expiration, but what we don't know is volatility. So usually what you're doing is solving for volatility, right? Options trading is volatility trading. You're trading volatility. On Wall Street, they don't even call these guys options traders. They call them volatility traders, right? So you have to have an understanding about volatility, which, you have to be able to understand some math, right? So if I was a math major in college, so I took calculus, I took differential equations, I took 2 semesters of probability and statistics. That's really all the math you need to know to understand options. In the course, we don't have Black-Scholes. We don't have the formula. We don't do any math equations. But what we show you is the mathematical relationships between things. So when you're talking about Greeks, when you're talking about like theta, which is the time decay of options, we show you how the value of an option declines over time, right? And really what theta is, it's a partial derivative of the price of the option with respect to time, okay? Anyway, I don't know if that makes any sense.
Yeah, it does, and it's helpful. It was explained in a way that that seemed Greek in prior textbooks. It's funny you bring up vol traders, like a volatility trader. I remember meeting a guy who was he was one of the main principals and one of the co-founders of a volatility firm called Artratis. I met him right after the financial crisis. He had become seemingly overnight become a billionaire. Just made a fantastic killing during the financial crisis. But then 3 years later, closed his firm. Because volatility disappeared. So, and it seems like all the vol traders are pretty much gone now.
Emmanuel Derman wrote a piece about this in 2000 when he was working for Goldman Sachs, when he was a strategist. He wrote this very famous paper called Regimes in Volatility, right? And basically in the markets, you do have regimes in volatility. You'll have 5 years where volatility is very low, and then like 3 years where volatility is very high, right? And generally, among volatility traders, you're generally only good at one or the other. You're either a long vol guy or you're a short vol guy. So what happens is that the option sellers, the short vol guys, they'll make money for like 5 years, and then vol will spike, and they'll all get wiped out, and the long vol guys will make money. So your friend, I'm sure, was a long vol trader, because during the financial crisis, like the VIX went to 90 and it stayed there. I got to tell you, during the financial crisis, the equity derivatives desks were the only desks on Wall Street that were making money, and they were killing it. I talked to one of the derivatives traders back then. He said during the financial crisis, everybody was broke. You could walk into any restaurant, it was empty. Any store was empty. He said he walked into Best Buy and he basically bought everything in the store for like $80,000. Like he had made millions during the financial crisis and everybody else got killed. And so it was such a weird time. The derivatives traders just killed it.
Would you say that now is a good time to get familiar with options based on what you've seen so far year to date?
So vol is up a bit. I didn't look at the VIX before I came in here, but I think it's probably around 16 or 17. But like I said, it did get up to about 25. With Trump as president, we are getting a lot of tape bombs. Policy is much more unpredictable. The whole world is much more unpredictable, which kind of argues for a higher level of volatility. And not just a higher level of volatility, but the volatility of volatility is going to be high. Volatility itself will be volatile. So yes, this is a perfect time to be learning about options. It's a great environment.
So if you don't think about options as a tool to get rich quick, but instead you think about them as insurance, this is a good time to have some insurance.
Yeah.
Yeah. Okay.
Well, 3 months ago would have been a better time.
Right. It's never too late. It's never too late. Where can people get more information on this?
JaredDillianMoney.com.
Okay.
Yeah.
Just go to your website.
Yeah.
Let's end on a fun note. Do you have any other option stories from your days on Wall Street?
2 weeks ago, I was in DC and I met up with one of my old floor trader friends, and he was telling me a story. So kind of like the New York Stock Exchange, you have specialist posts, but they call them something different. They call it an LMM, a lead market maker. But he's essentially the specialist, and he was making markets in 50 options on 52 different stocks. And one of them was Eastman Kodak, right? So this is 2003. And, Eastman Kodak is still making film cameras, right? And everybody's expecting them to go digital. Okay. So first of all, there's a lot of internet stocks. Like nobody ever trades Eastman. Nobody cares about Eastman Kodak. Right. So my friend has to go to the bathroom. He's got to go pee. And he gets one of the other traders to come over to just watch the specialist post for like 5 minutes while he goes to the bathroom. Well, this guy leaves and a broker comes over with an order to buy 1,000 puts in Eastman Kodak, like teeny puts, not teeny, but they were like an eighth. They cost like an eighth. They were down like 40%. So my friend comes back from the bathroom. He's like, what happened? He's like, oh, Bear Stearns bought 1,000 puts for an eighth. He's like, you sold them? He's like, you did what? So he immediately, like he raises his bids on the screen. He's trying to buy them back for a quarter, 3/8, a half. He's calling other exchanges. He's trying to buy as many as he can. And he gets like 200 of them. And at the close, Eastman Kodak announced that they were staying with film cameras. They weren't going with digital. And the stock was down 40%.
Somebody had insider information.
Or either that or they were very lucky.
Yeah. Interesting. What else should we cover? Anything that I missed that I should ask you?
No, I think that's it.
Always fun. Thank you, Jared.